You have been a loyal customer for years. You pay on time. You auto-renew. You never cause problems. And because of all of that, you are now paying more than the person who signed up last month. Not slightly more, significantly more, for the exact same service. And it's not just one industry. Your car insurance company charges long-term customers an average of 47% more than equivalent new customers. Your internet provider is currently offering new subscribers a rate $30 to $50 lower than what you pay. Your cell phone carrier has a new customer deal right now that is significantly better than your current plan. Your streaming services have raised prices on existing subscribers while offering lower rates to win new ones. You are being penalized for loyalty across every subscription in your life simultaneously. By the end of this video, you're going to understand exactly why this happens, which industries do it most aggressively, and how much it is costing you right now in total across all your subscriptions. And I'm going to give you a specific 2-minute phone call script, tested and documented, that returns loyal customers to new customer pricing at a success rate of over 60%. Stay with me. The script alone is worth the watch time. Let's define the term with precision. Loyalty penalty pricing, also called the loyalty tax, price walking, or inertia pricing, is the practice of charging existing customers more than new customers for an equivalent product or service. The mechanism relies on one specific consumer behavior, inertia, the assumption that most customers will not switch even if a better price is available, because switching requires effort, and effort has a cost. The company monetizes your inertia. Your loyalty is not rewarded, it is exploited. And here is the total cost to understand. A 2023 analysis by the consumer advocacy organization Consumer Intelligence Research Partners estimated that the average American household overpays by approximately $1,200 per year across insurance, telecommunications, and subscription services, purely due to loyalty penalty pricing. $1,200 per year, not from being defrauded, not from a hidden fee they didn't know about, simply from staying with companies they already trust and not asking for the new customer rate. To understand why loyalty penalty pricing exists, you need to understand one specific piece of subscription business economics: customer acquisition cost versus customer retention cost. Acquiring a new customer through advertising, promotions, sales commissions, sign-up offers, costs a company 3 to 5 times more than retaining an existing one. That is a well-documented industry ratio, which means a company has significant financial headroom to offer new customers a steep discount while simultaneously raising rates on existing customers who are unlikely to leave. The new customer discount is funded, in part, by the loyalty penalty charged to you. You are subsidizing the deal being offered to the person who hasn't signed up yet. And here is the specific analytical framework companies use to determine exactly how much they can raise your price before you leave. It's called churn modeling. Every major subscription company, insurance, telecom, streaming, gym, runs continuous models calculating the relationship between price increases and customer departure rates at different tenure levels. The model identifies the exact price point at which the switching effort for a long-term customer becomes worth it. Below that threshold, the company raises the price. They know your number, and they stop just below it. Every single year. The most rigorous academic and regulatory documentation of loyalty penalty pricing comes not from the United States, but from the United Kingdom. In 2018 and 2019, the UK Financial Conduct Authority, the FCA, conducted a comprehensive investigation into loyalty pricing across 5 sectors: home insurance, car insurance, home credit, cash savings, and mortgages. Their findings were unambiguous. In home insurance alone, Loyal customers were paying on average 33% more than equivalent new customers. The FCA estimated the total loyalty penalty across the 5 sectors at over £4 billion annually. They used the phrase loyalty penalty explicitly in their published findings. And in 2022, they banned the practice in insurance. Auto and home insurance is the category where loyalty penalty pricing is most extensively documented and most financially significant. The mechanism has a specific name in the insurance industry: price walking. A new customer receives a competitive introductory premium, priced aggressively to win the sale. In year 2, the premium increases slightly. In year 3, slightly more. By year 5 or 6, the customer is paying a rate that bears no relationship to their actual risk profile. It is a function of their tenure and their demonstrated reluctance to switch. The consumer assumes their premium reflects their risk. It reflects their inertia. Telecommunications, mobile phone plans, and home internet is the second most significant loyalty penalty category by total household dollar impact. The mechanics here are slightly different from insurance because telecom companies use promotional pricing rather than price walking. A new customer receives an advertised promotional rate, 24 or 30 months of discounted service tied to a device installment plan or introductory contract. When the promotion expires, the rate increases to the standard rate, which is the loyalty penalty rate. And because the device is often tied to the plan, switching carriers requires paying off the device balance. The device installment plan is also a switching cost. The two mechanisms work together. Streaming services represent the newest and fastest evolving version of loyalty penalty pricing because the architecture is reversed from insurance. Rather than gradually walking prices up on existing subscribers, streaming services use a combination of tier degradation and new subscriber promotions. Netflix, Disney+, and Max have all introduced lower-cost ad-supported tiers specifically to attract new subscribers at a lower entry price, while simultaneously raising the ad-free tier price that existing subscribers pay. The loyal ad-free subscriber pays more every year. The new ad-supported subscriber pays less to enter. Same content library, different price, different tier. Designed to maximize total revenue across both cohorts. The gym membership is the loyalty penalty example that most people encounter first, because gym promotional pricing is advertised in the most publicly visible way. Planet Fitness regularly advertises $1 enrollment and $9.99 per month for new members. Existing members who joined at a higher rate during a non-promotional period pay $24.99, 2.5 times the current new member rate. The existing member's rate is locked in contractually. The new member's promotional rate is also contractually locked. 2 contracts, 2 prices, same treadmills. Planet Fitness has over 18 million members. The majority pay more than a new member would pay today. Home insurance is the loyalty penalty category with the single largest dollar gap between new and existing customer pricing, and also the category where most consumers are least likely to shop around because the switching process feels complex and the consequences of being uninsured feel high. A 2022 Consumer Reports investigation found that long-term home insurance customers paid on average $550 more per year than equivalent new customers for the same coverage level on the same property. $550 per year. The most loyal home insurance customers, those with 10 or more years with the same insurer, paid the highest premiums of all. Internet and cable service is the loyalty penalty category where the consumer counterplay is most well documented and most consistently effective, because cable and internet providers operate in limited competition markets and have specific retention budgets allocated to customers who call and threaten to cancel. The retention department at Comcast, AT&T, Spectrum, and Cox has the authority to offer rates at or near new customer promotional pricing to customers who call and use the right framing. This is not widely advertised. The discount is available. It requires a call, and it requires knowing specifically what to say, which is exactly what the tools section of this video is going to give you. Quick pause. I want to know, which loyalty penalty is costing you the most right now? Car insurance, internet, cell phone, gym? Drop it in the comments with the category and your rough estimate of how much more you're paying than a new customer would pay today. Because if you've already run this math and it made you angry, I want to know that number. Let's name specific companies. State Farm is the largest home and auto insurer in the United States, and it has been specifically named in academic and regulatory analyses of loyalty penalty pricing. A 2019 study published in the Journal of Risk and Insurance analyzed pricing data across major U.S. insurers and found that State Farm's long-term customers paid premiums significantly above actuarially justified rates, meaning the premium exceeded what the customer's actual risk profile warranted. The gap was not driven by risk. It was driven by tenure and demonstrated inertia. State Farm is not unique in this. It is the largest example of an industry-wide practice. Comcast is the most documented case of a company that simultaneously operates a loyalty penalty pricing model and a retention department specifically designed to reverse it when confronted. Consumer advocacy forums, particularly the subreddit r/Comcast and the Bill Fixers database, have compiled thousands of documented cases in which long-term Comcast customers called the retention line, used cancellation language, and received rate reductions of $20 to $40 per month. The retention department has specific authority to offer promotional pricing to at-risk customers. That authority is not available through the standard customer service line. It requires specifically requesting the retention or cancellation department by name. Verizon and AT&T have refined the loyalty penalty to its most structurally elegant form, the device installment plan. By bundling the phone payment into the monthly bill, both carriers create a switching cost that operates independently of the service price. A customer on a 24-month device installment plan who wants to switch carriers must either pay off the remaining balance, often $300 to $500, or pay both the old carrier's installment and the new carrier's service fee simultaneously during a transition period. Both carriers know the payoff balance at all times. The promotional new customer offers they advertise are specifically designed to target customers whose installment plan has just ended, the moment the switching cost drops to zero. Netflix's loyalty penalty mechanism is worth examining specifically because it is the most sophisticated version of streaming tier architecture, and because Netflix has been more transparent than most about the revenue logic behind it. When Netflix launched its ad-supported tier at $6.99 per month in 2022, it was not primarily a response to subscriber loss, though subscriber loss had occurred. It was a revenue optimization architecture. The ad-supported tier generates revenue from two sources simultaneously: the subscriber's monthly fee and advertising revenue from brands paying to reach that subscriber. The ad-free tier subscriber pays more, generates zero advertising revenue for Netflix, and subsidizes nothing. The ad-tier subscriber pays less and generates additional revenue beyond their subscription fee. The new pricing architecture is more profitable per subscriber than the old one. For certain cohorts, Amazon Prime deserves a second mention in this episode, separate from Episode 7's escalation chart, because Prime represents the most complete example of the switching cost architecture deliberately engineered to make the loyalty penalty invisible. Amazon has systematically added services to Prime membership over 20 years: video streaming, music, photo storage, pharmacy discounts, grocery delivery, reading subscription. each addition increasing the subscriber's dependency on the bundle and the switching cost of leaving. By the time the annual price reaches $139, the subscriber isn't paying for Prime. They are paying to not lose everything they've built inside Prime. The price increase is irrelevant. The exit cost is everything. And here is the most counterintuitive element of the loyalty penalty story, and the one that most people find the most genuinely surprising. Loyalty programs, points, miles, rewards, cash back, are specifically designed to increase the switching cost for customers who would otherwise be most likely to respond to the loyalty penalty by leaving. The customer who is being overcharged by 30% is also the customer most likely to have accumulated significant reward points. Leaving means losing the points. The loyalty program and the loyalty penalty operate as a single coordinated retention system. The reward is the lock. The penalty is the revenue. They work together. In 2020, internal Comcast documents obtained through a consumer advocacy investigation revealed that the company's pricing strategy explicitly segmented customers into price-sensitive and price-insensitive cohorts and applied different price increase cadences to each. Price-insensitive customers, those who had demonstrated by their behavior that they would absorb increases without switching, received larger annual increases. Price-sensitive customers, those who had called to complain or had a history of negotiating, received smaller increases or promotional holds. The company knew which customer you were and priced you accordingly. The single most effective consumer tool against loyalty penalty pricing is also the simplest: a phone call. Specifically, a phone call to the retention or cancellation department using a specific two-part script. Part 1, the opening statement. I've been a customer for X years. I've been reviewing my bill and I've noticed that new customers are being offered specific new customer rate. I'd like to discuss bringing my rate in line with what new customers are being offered, or I'll need to consider canceling. Say those words exactly. Do not apologize. Do not hedge. State the fact and state the consequence. Part 2 of the script, handling the counteroffer. The agent's first response will almost always be one of three things. Response 1. Let me see what I can do. This means the retention process has begun. Stay on the line. Response 2. Your current plan is our best available rate. This is rarely true. Counter with, I understand. In that case, can you transfer me to your cancellation department? Response 3. An immediate offer. Evaluate it against the new customer rate. If it doesn't match, say, I appreciate that. I'd still like to be closer to the new customer rate, or I will need to cancel. Then stop talking. Silence is your most powerful tool after the statement. Tool 2. Bill negotiation services. If the call feels uncomfortable or you'd rather not make it yourself, there are services that make the call on your behalf and only charge you if they successfully reduce your bill. Bill Fixers charges 50% of the first year's savings. If they save you $300, they keep $150. Trim and Rocket Money offer similar services with slightly different fee structures. These are not scams. They are services staffed by people who make these calls professionally, all day, every day, and know exactly which scripts work for which companies. Tool 3 is a system rather than a single action. The annual bill audit. Once per year, for every recurring subscription in your life, do 3 things. 1. Find the current new customer rate for that service. 2. Calculate the gap between what you pay and what a new customer pays. 3. If the gap exceeds $20 per month, make the call or use a negotiation service. A simple spreadsheet, 1 hour per year. The average household that runs this audit and acts on it recovers between $400 and $800 annually, documented across multiple consumer finance studies. 3 tools. Fast. 1. The cancellation call script. 2 parts. Say the words exactly. Request retention department by name. Silence after the final statement. Success rate over 60% for customers with 3 or more years of tenure. 2. Bill negotiation services. Bill fixers, trim, Rocket Money. They make the call professionally. No savings equals no fee. 3. The annual bill audit. 1 hour per year. Every recurring subscription. Gap over $20 per month means call. The penalty is real. The tools are free. The call is worth making. Let's close the loop on why this continues. The loyalty penalty persists for the same reason every system in this series persists. Because it is measurably profitable. The market does not self-correct it, and regulation has been slow and incomplete. The FCA banned it in UK insurance in 2022. The practice continues in virtually every other category and in virtually every other country. The US has no equivalent comprehensive regulation. The CFPB has issued guidance. The FTC has investigated individual cases. The practice remains standard. The consumer's most effective tool is not waiting for regulation. It is making the call. 8 episodes. Paint, glasses, mattresses, beer, store brands, prescription drugs, hidden fees, loyalty penalty. 8 completely different industries. 8 different historical origins. 8 different product categories spanning everything from what's on your bathroom shelf to what's on your monthly bank statement. And every single time, without exception, the same architecture. A market that looks competitive from the outside. A pricing system invisible from the inside. A consumer paying more than they should for longer than they realize, in a way that is entirely legal, extensively documented, and almost never discussed. Final summary. Fast. 1. Loyalty penalty pricing, also called the loyalty tax, price walking, and inertia pricing, is the deliberate practice of charging existing customers more than new customers for equivalent service. 2. The average American household overpays approximately $1,200 per year across insurance, telecom, streaming, and fitness due to loyalty penalty pricing. 3. The behavioral mechanism is inertia. Companies model your switching threshold and price just below it every year. 4. The FCA banned the practice in UK insurance in 2022. The US has no equivalent comprehensive regulation. 5. Loyalty programs. Points, miles, rewards are specifically designed to increase the switching cost that makes the loyalty penalty possible. The reward and the penalty are one coordinated system. 6. The cancellation call script works. 2 parts. Request retention department by name. Silence after the final statement. 60+% success rate for customers with 3 or more years of tenure. 7. Run the annual bill audit once per year. 1 hour. Every recurring subscription. Gap over $20 per month means call. The penalty is recoverable. Most people never try. Episode 9. And this next one, this is the one that's going to make you look at every job you've ever applied for, every salary you've ever negotiated, and every raise you've ever received completely differently. Because we're going into salary compression. The phenomenon where the person hired last month earns more than the person who has been in the role for 5 years. We're going to explain why this happens in almost every major employer in America, why HR systems are structurally designed to produce it, and what the one conversation you can have with your manager that has a documented success rate of changing it. Stay with me on that one. It is the most personally actionable episode in the series. If this video gave you something useful, the script, the audit framework, the vocabulary to describe something you've been experiencing for years without being able to name it, hit subscribe and hit the bell. And share this specifically with someone who auto-renews everything and never calls to renegotiate. Because the loyalty penalty is most expensive for exactly that person. The call takes 2 minutes. The script is in the pinned comment below. The savings are real and they are immediate. See you next week. One specific ask. Think of one person in your life who auto-renews every subscription, never calls their insurance company, and has been with the same internet provider for 4 or more years without renegotiating. Text them this video right now. Tell them the pinned comment has the exact script. Tell them it takes 2 minutes. Tell them the success rate is over 60%. That is a direct and immediate financial benefit for someone you know. That is the share. Send it.